The global economy continues to display remarkable resilience, with inflation declining steadily and growth holding up. The chance of a soft landing has increased, but the pace of expansion remains slow and risks remain. On the demand side, global activity was supported by stronger private and government spending, despite tight monetary conditions. On the supply side, increased labor force participation, mended supply chains, and cheaper energy and commodity prices helped, despite renewed geopolitical uncertainties. Global growth under our baseline forecast will be steady at 3.1% this year, a 0.2 percentage point upgrade from our October projections, before edging up to 3.2% next year. Important divergences remain. We expect slower growth in the United States, where tight monetary policy is still working through the economy, and in China, where weaker consumption and investment continue to weigh on activity. In the euro area, activity is expected to rebound slightly after a challenging 2023, when high energy prices and tight monetary policy restricted demand. Many other economies continue to show great resilience, with growth accelerating in Brazil, India, and Southeast Asia's major economies. In sub-Saharan Africa, growth is projected to rise as the negative effects of earlier weather shocks subside and supply issues gradually improve. Inflation continues to ease. Excluding Argentina, global headline inflation will decline to 4.9% this year, down 0.4 percentage point from our October projection. For advanced economies, inflation will average around 2.6% this year, close to central bank targets. With the improved outlook, risks are now broadly balanced. On the upside, disinflation could happen faster than anticipated, allowing central banks to ease sooner. Announced fiscal consolidation measures may be delayed in what is the biggest global election year in history. This could boost economic activity, but also spur inflation and increase the prospect of disruption later. On the downside, renewed geopolitical tensions, especially in the Middle East, with increased attacks on ships in the Red Sea, could disrupt commodity and supply chains. Core inflation could also remain high as services inflation proves more persistent, and wage developments could also add to price pressures. Finally, financial conditions could tighten, raising long-term interest rates and putting renewed pressures on economies and governments.